Welcome to the Treasury Update podcast, presented by Strategic Treasurer, your source for interesting Treasury news, analysis, and insights in your car, at the gym, or wherever you decide to tune in.
Welcome to the Treasury Update podcast. This is Craig Jeffery, and today's episode is called Working Capital, Thriving in Uncertain Times. I'm joined by Dan Reeves from Esker and Brian Rieber from LSQ. Welcome to the podcast, Dan and Brian.
Thank you, Craig.
Thank you for having us. Yeah, thanks very much.
Let's jump in. We'll get into your background in a few moments, but let's talk about the situation that companies are finding themselves in across a range of industries and specifics. There's a lot going on from a macroeconomic, geopolitical perspective. Just tell us what's going on and calibrate that for us. And Dan, if you'd start, and then I'll look to you, Brian, to close out that topic.
I was in Salt Lake last week. Managed to combine some business with pleasure, a few days of great skiing, and then I was there and I thought I'd go and see some customers. And the trend across companies from the high-tech space through to building materials and aggregate type companies, I went to see three companies and the trend was similar. I think the financial leaders there have said, look, we need a controlled spend. We need to have better visibility of what we're buying. We need to focus on a cautious approach, just in case approach. So that means all of those companies, and before that visit and prior, companies I've spoke to, customers I've spoke to have all said, hey, there's some kind of working capital focus. There's a working capital initiative of some sort. Or maybe we've been a bit more careful about what we do with stock. In many cases, I think companies are having to have more stock because of supply chain disruptions, and therefore they have to have more stock so they can satisfy their customers. That's expensive. And so I'm seeing across both receivables and procure to pay, obviously I can't really help companies with stock, reasons companies would turn to Esker is because they're trying to improve working capital either on what they do with receivables or what they do with payables.
So you mentioned a couple things about controlling and managing working capital. Is this just in case? Is that concerns about certain macroeconomic conditions, inflation, interest rates? What is driving that in their discussions?
Yeah, we did some research with TCU last year, Texas Christian University, and their Neely Research Institute, and they were looking at what's going on. Our company's sitting on more cash, has working capital improved, and they saw a significant uptick in companies sitting on more cash. And there's this trend from just in time to just in case. And what that means is companies are worried about inflation and the impact of inflation. I think I've had companies say to me, everything is late all the time. Some of my customers have said that to me. And so I think the reality is it all down, whether you pin it on the, what's going on in Ukraine and geopolitical issues, I'm not sure. But the reality is, I think most companies now are saying, hey, we fully expect there to be supply chain issues. We are aware we may need to have more stock at hand. And companies have increasingly really started to focus on what can we control here, receivables and payables, and maybe looking to see if you can take advantage of supply chain financing or working capital opportunities. That's something folks can do. And I think the other thing that's going on, a trend we didn't talk about yet, was freeing up staff to do the type of work they enjoy, getting people out of manual work, because there's a couple of things that trends have continued there, is folks want to do work they enjoy or they leave. It's hard to onboard new, or let alone find new staff, so you better find them the type of work that's engaging, the work provides value to your customers and suppliers, the work that's of interest to them, or they're not going to stay. And so retention and training of staff is another issue that I think that finance leaders, supply chain leaders are having to deal with.
Some really good points there, Dan. Brian, maybe you can pick up the discussion as well back on the macroeconomic side. What are you hearing from that perspective to add to Dan's points?
I've heard exactly what Dan has heard from customers, and it doesn't matter whether we're skiing in Salt Lake or enjoying the beaches in Florida, down where LSQ is headquartered, or in Europe and Asia. It's a consistent theme. But I would maybe take it a step further and say, what have some of those factors impacted in terms of actions, right? And what we've seen over the past 2 years are companies have increased that stock. They've tried to do their best at forecasting demand, and that's proven to be largely impossible for many companies. So they've not wanted to miss out on that revenue growth. They've increased inventory. They've allocated and borrowed capital to make sure that they could account for supply chain disruptions and delays. Well, the consequence of that over the last 10 years and exacerbated in the last 2 has been a significant amount of debt that's been added to our clients' balance sheets. And while they had difficulty forecasting their demand, none of them forecasted the rate with which interest rates would change. So you'd ask in terms of what that impact is. We see a lot of treasurers and CFOs who, in a candid conversation, would say they got caught off guard, right? It moved too fast. Now they're playing defense and trying to figure out how to service the financial commitments and promises they made, and allocating more cost to just covering money than what was that. So these decisions, the macroeconomic effects, the supply chain disruptions, the geopolitical events, and the cost of money and the speed with which the cost of money has risen are all related. And what that has really done is put some unprecedented constraints and challenges in front of our treasurers and CFOs today that we've not seen in our generation.
Yeah, let's do a quick background. Love for each of you to give a quick overview of your responsibilities. Brian, since you were most recently talking, why don't you give your elevator pitch of what you do at LSQ, a little bit about your background, then we'll jump over to Dan.
My role at LSQ is the Vice President of Working Capital Solutions. So I work with upper mid-market to enterprise customers from a few $100 million to $20 billion in spend, and providing predominantly supply chain financing solutions and helping them optimize working capital more from a payables focus. As a company, we have a separate team who's extremely experienced and focused on the AR side of the house. But as a firm, this is what we do. We manage working capital for some of the biggest companies in the world and all of their suppliers.
Great. And you're located near the beaches in Florida. Okay. And over to you, Dan, just background.
The title is Vice President of Sales for the Americas, and my job is to support the folks at Esker who are providing solutions to predominantly North American companies, but many global. As I said, I've been here over 25 years. Esker's been in business over 35 years. And companies turn to Esker, so typically engage with finance leaders, supply chain leaders, customer service leaders. And companies turn to Esker when, as I said earlier, the expression I like to use is they're trying to free up folks in the receivables or payables, credit or customer service departments to go and be rock stars. What I mean by that is, one, as I said, if you want to keep your staff, use technology to free them up to go and do work that's engaging so they stay at your company. And perhaps they're now able, instead of keying orders or invoices, they can deliver invoices to your customers faster with the information that's needed. They can chase up customers, given smart insights as to who to chase and who can you chase and work with to get paid earlier. What can you do to automate and improve the match rate on the back end of your cash application process? What can you do on payables to ensure your suppliers get paid quickly, they're happy, and you identify, hey, looks like there's some maverick spend over here, looks like we could take better advantage of some sourcing opportunity over here and therefore reduce the costs we pay. So a lot of it is about freeing up folks in, as I said, receivables, payables, customer service functions, effectively arming the CFO to have better visibility, make smarter decisions, control costs, optimize days payable outstanding, optimize days sales outstanding, and wow customers effectively.
We started on some macroeconomics and what you're hearing from customers. You mentioned there's working capital initiative seems to be underway everywhere. I don't know if you can give some examples without naming names or dive into some of those conversations a little bit more. You've touched on some, but are there other things that would be helpful for our audience?
Yeah, I think what I've seen over the last year or so is, if we focus on the working capital side, I've seen two things. If I think about the receivable side, I've seen a lot of companies that are owned by equity groups, PE firms, etc., approach Esker because they've been instructed to improve their working capital. They've been instructed to improve age debt. They've been instructed to improve the balance sheet. So we've had a lot of interest, a lot of projects go ahead because of that focus from the PE firms, the holding companies that own these companies. On the payable side, one of the things that's been really interesting is going back to existing customers that use Esker for procure to pay and making them aware there's now an embedded finance option within the platform. And what that means in plain English is sometimes the company will say, hey, we've got plenty of cash, we're in a really strong position, we can move the invoice around the organization, and my term is at the speed of 1,000 gazelles, because now they can reduce any delays, they can get the invoice in, coded, approved really quickly, they can use AI to help match, do three-way match, to automatically suggest the right coding. So they can get the invoice in and around the organization far faster than ever before, which means that now, if you've got cash in the bank, or you have access to a embedded finance provider like LSQ that's weaved into the Esker platform, it means now that your suppliers, especially the treasury team or the finance leaders over there, who are hungry and hungrier than we've ever seen to get paid, they're more likely to respond if you sort of put out some notes there to say, hey, we can pay you, but we can pay you faster in return for a slight discount. Because we're seeing that companies are taking this mindset of, yes, we want to extend terms or standardize terms. Yes, there's opportunity here to possibly make this technology self-funding by earning more early payment discounts. Though there's also this element, hey, I don't want to lose my place in the queue. There's lots of disruptions. I cannot afford to move from third favored customer to fourth favorite customer, for example. So I do want to make sure that we pay these suppliers quickly. They can see when they're going to get paid. We make it easy for them to come online if need be and see, here's what we're going to pay you, and any deductions, so that they are in a position themselves to go carry on buying goods and services from you. There's some of the trends I'm seeing, and it's been interesting. If we go back maybe a year and a half, 2 years ago, was there so much interest? No, I really don't think there was. Or people were talking about, hey, you can turn your finance team into or your payables team into a profit center. Well, suddenly that is real based on the dramatic increase in the cost of borrowing. The food on the stove was sort of simmering. Now it's burning. Now there's, you mentioned working capital, it seems to anybody, and most companies I'll talk to say, yeah, we have some kind of initiative. Yeah, that's a focus. Yeah, there's pressure from the top.
Yeah, we've definitely seen that. Working capital, supply chain financing very much came back in vogue with a vengeance in the last 6-9 months, maybe a little bit more. Yeah, shifting over to LSQ. Brian, any other things that you're hearing from customers that reflect on either the economy, the situation that we're in?
Yeah, I think we could build off of what Dan said too. What I'm hearing from customers is that over the last 2 years, 3 years, maybe more, there were two things happening, right? One, we had free money. It was relatively cheap. But two, they were all focused on the top line. Right. One of the things that Dan was just saying when we talk about inventory and growth, what you didn't hear 2 years ago was how do we cut costs? It was more, how do we make sure we're growing revenue? Everybody had a different mindset, right? As soon as they realized it wasn't the end of the world with the pandemic and they could actually grow revenue, it was all in. What we're hearing today from customers across many, many industries is a few things. Number one, they have plenty of product to sell. Largely those supply chain delays, particularly in seasonal businesses, they missed their inventory shipments, right? So if your heavy sales were Q4 and you tried to have things arrive in October, they arrived in December, it was a little late. And thus they're sitting with excess inventory. So now they're focused on how do we control costs? How do we make sure we exploit this, keep our margins healthy in the current year without just consuming it on interest? And they're starting to look at AP and AR specifically. What I would say is the mismatch between AP and AR. We have a lot of customers who are finding that their customers are also suppliers. And, they're paying their customers bills in 30 days, yet they're not getting the AR side paid for 60 or 90 days because they were ahead of them. So there's really a focus to say, hey, wait a minute, let's just at least make this equal so that we can close an APAR mismatch with the same person, with the same partner. We also see clients saying it's time we start looking at data, and we've been growing revenue so much that these suppliers have often negotiated individual contracts. We've agreed to things to just get product in hand. I was working with a client earlier today. They're in the retail business. And for the same supplier, they have 7 different payment terms that range from net 0 to net 90. And it's the same supplier. It was crazy. They're like, okay, well, if we could just, put this in the middle, we'd be in a better spot. So we're starting to really see these conversations take place of how can we leverage data? How can we work with our suppliers to make sure that we don't want to pass a burden off to them. They need to survive too. But we can work smarter, right? And we can control our costs and improve working capital for everybody so we all grow.
You mentioned, we moved off of a period of free money, right? Interest rates were almost at zero, certainly at the Fed level, and they've changed and shifted dramatically. The other factor too is not everyone has access to capital at the same level. Like larger firms with higher credit ratings usually have access to quite a bit. That is not the same, throughout the typical supplier economy. I think, Dan, you mentioned just in case a few times, right? Everything's slow, everything's late. There's just in case for inventory, but there's also just in case for cash and liquidity that we had a little bit of a discussion on. So anything else that you're hearing in terms of how do we protect our trading partners? If you're talking to a large buyer, they're trying to protect their suppliers, or they're trying to manage working capital without breaking the other components in their ecosystem. Either of you have any comments on that? What you're seeing or hearing?
Well, it's definitely a theme that I hear more and more every single day. For many years, we've heard the affordable capital, right? But the access to capital is becoming very real, right? If we go back to 2008 and 2009, those of us that were around and working in the field, the challenge was a liquidity crisis because nobody had access to capital, right? The banks were sitting on these balance sheets, but they wouldn't lend. And today, there's a lot of capital out there. Interest rates are rising, but what's happening is things are flowing downhill. So your higher investment grade and even your higher end of non-investment grade clients are getting access to capital. It's become more expensive as to be expected. But, those that are on the lower end of investment grade or private unrated companies are finding that the investors are happy with the yields that they can get with other companies that they feel are less risk, and they're simply pulling back. So there's less available. And that impacts a lot of suppliers, but in particular, a lot of DEI suppliers we find. So, there's these competing initiatives of companies, and how do we manage this space? So I would say, Craig, there's a huge challenge with access to affordable cash that exists today in the mature banking world. We are seeing investors who do have the cash be a little more constrained about where they're deploying it, and instead of maybe pulling back a little bit, a lot of times they're just saying, we're going to go to zero and just pull the Band-Aid off, but we've got other investments that they're making. And that's leaving a lot of people who have to respond quickly, who haven't had the savings built up over the past few years. So it's a big concern. It's going to be exacerbated. And I think solutions like what we do in partnership with Esker on the AP and the AR side, it's not surprising our phone is ringing significantly more frequently in the last few months with these exact conversations.
Dan, any variants or additions to what Brian said?
Yeah, I think one thing I've seen for the payables folks is that during the pandemic, many companies felt the need to diversify and have more suppliers in case there was a problem with one supplier. With that came a lot more work. So for many organizations, adding a supplier was a fair bit of work, and it would often either fall on AP or fall on procurement. And obviously you need some SOX controls in there to be, control who can onboard a supplier. What I've seen is a couple of different things. One is, okay, well, we might want to have more suppliers, but guess what? We've got to make sure that We're not going to fall foul of any OFAC checks. Hey, are these folks based in Russia? If we need to know if we can deal with those guys. Just as a crazy example, but companies want to make sure that they're okay. We're going to do more, extend our supplier base. Well, we better make sure these folks are good actors. We've got the right bank details. We're not going to fall foul of some bad actors here. So there's due diligence needed. There's process needed. There's also, I'm finding companies are saying, well, I need to ensure that these suppliers are trained, abide by a code of conduct, and that each 6 months or year, I'm both checking that they've been trained, they've got the right insurance, they're going to represent us. They're not going to embarrass our brand. There's no child labor going on, or we just need to be a bit more diligent, and that takes work. And so what I'm finding is companies are saying, hey, if anything, I need more suppliers. I need to bring them on quicker, but I cannot sort of do away with the necessary controls to protect our brand or protect our company. In our world, what that means is folks saying, hey, I need to have a supplier enablement, a supplier portal that's easy for us to use, speeds up the ability to bring on a supplier, and I'm not necessarily pushing all the work on the supplier. It needs to be good for all of us, but we need to use some technology because we need to speed that process up without putting ourselves at risk.
Yeah, very good. A last core section to talk about, this topic of working capital thriving in uncertain times. I wanted to talk about financial levers. In addition to just reacting, how do we pull levers that free up capital or help our partners or support supply chain security? This broad question of, will your supply chain be ready? Is your financial situation strong enough, or what do you need to do there? Brian, I want to start off with you and do some back and forth here between you about what's mattering here, and any section you'd like to start off with, Brian.
Well, we should probably start off with accounts payable, since it's near and dear to both Dan and I's hearts and what our companies do. So,
should everybody have those 7 different payment terms for a single supplier?
Yeah, it's like, why so few, right? Can you add 10 more? What I would say is, from an AP standpoint, I actually think AP is kind of the redheaded stepchild of working capital. It is amazing to me how many treasurers I talk to that say they focus on inventory. When they think of working capital, they focus on inventory. Maybe they know their AR head of collections and they talk to them about what they could do to speed up payments. They really don't spend a lot of time on the AP side of the house. And I don't know if that's because they either don't have the relationships or don't see that lever. But, if we look at the companies who are leading industry packs of working capital, the industry benchmarks for working capital, in almost every scenario, you see that accounts payable is best in class, right? And even if the others are mediocre. So, when we think about a lever that's often untapped for many companies, it's coming out and engaging their supply chain counterparts, the head of AP, and really having a conversation using data to figure out how they can impact this lever and have a pretty big impact on their working capital in a short period of time, right? So for me, clearly it's a little self-serving. But I will tell you, I've been doing this for 20 years, and it's amazing how many conversations I have where it's like the first time we're having this conversation.
What I read an article that said, hey, a few articles I've read that said tech funding will go up. However, due diligence and scrutiny by CFOs will also go up. And many CFOs are worried about, okay, well, there's technologies there, but can you truly deploy technology that's going to help us with receivables and payables and supply chain financing that my teams are going to use, embrace, my suppliers are going to adopt? There's metrics out there that something like only 18% of digital transformation initiatives really work. So, and I think plenty of CFOs, they can't get the staff. They're obviously under pressure to transition the roles so staff stay. But at the same time, they're like, well, how do I make sure this technology sticks and works and I get the return on investment? Because if I do it right, when they put in transformations that work, what I've seen is that companies say, wow, suddenly we believe we can do it around here. And employees and various people want to get on board. But when it doesn't go well, now there's, that's problematic for the future. So some of the things I think that are really important right now is if folks, to your point, in payables want to talk about, hey, we've got this technology, it can pay for itself. Yes, it can help the suppliers, but we're going to free up more working capital. They have to go armed with business cases. They have to go armed with business cases specific to their own data. For the CFO, I find in many cases, he or she to say, yes, I'm interested, yes, I'll back this. They want to see, okay, show me how this is going to work. Show me how many suppliers are already on your network, or show me that you've done due diligence to prove this will work. And then I want to water that number down a little bit and be conservative. So I think the opportunity there is, yes, build relationships across, with treasury and finance, but you have to have any payables manager, procurement leader has to have data that's based on their own data so that internally the stakeholders will buy into it versus, oh, that's just another sales pitch. I think that's become even more important than ever in the last year. And the other thing I would see is I'm seeing projects go ahead when finance leaders say, hey, so this technology can help us both in payables and receivables, and also on the cash application side. So I can pay my suppliers quicker, I can send my invoices quicker, more efficiently, chase that money, apply that cash. What we're seeing is folks are buying into this idea of best of suite. Best of breed's been there for a while, but when folks realize, hang on a minute, I can get benefits for various parts of my company, one supplier to have to deal with, and I'm seeing more interest in that than I've ever seen. Finally, I'm seeing payables folks and receivables folks actually collaborate and talk and share ideas and get together and say, oh, this could benefit both of us. There's been times when I haven't been able to put my finger on why has there been so much interest there in the last 2 years, but I'm definitely seeing folks buying into the idea of technology that can be beneficial for more than just one department.
That's interesting, in terms of how you mentioned a couple of those items. The efficiency play has been probably number one for AP and AR for a long time. That's their key focus. Treasury is like, we need capital, we need to optimize capital, but they're all part of the same cash conversion cycle. So, what you're saying is now that we've gone from 0% essentially 0% Fed funds rate to like 5% in a very short period of time. Now it's like, okay, now it matters. The accessibility of capital, the willingness to get capital, put some pressure on there. And this idea that having better visibility, allowing us not to say we're going to pay in 45 days because it takes us 45 days to approve items, means we can put our capital to play, or we put third-party capital to play. So it gives more people levers. It's not just the lever that I pull if I'm paying. I pay later. I'll go from 60 to 90 days. I pay later. Everyone else suffers. There's additional levers, and there's some cost to that, but there's some additional levers in play. I don't know if I said that right, or if there's anything else you wanted to add about financial levers and maybe broadly supply chain security, right? Your partners.
So a lot's been said on that, but I think what I would add is that AR relationship that Dan was talking about, and your point of the process efficiency. And, if we go talk to AP or AR, they're always focused on process and efficiency as a cost center, right? I think it's a mindset of what they're doing. But what is not necessarily discussed in those individual units is what the treasurer and the CFO cares about, even more than the process efficiency, is what's the cash cost? What's the working capital impact? These decisions, there's a cause and effect of everything. So I think we're finding people are more and more in tune to the fact of what are the unintended consequences. It's funny, I had a conversation with a PE-owned firm that, partnered with a bank. They wanted to go to electronic payment methods. Well, they lost 5 days of float, and all of a sudden weren't prepared for that as a highly leveraged company because they stopped mailing checks. And in an interest rate environment that we're seeing today, particularly as somebody highly levered, that's a material amount of money that, they started consuming, that they went, oh boy. The process became a lot more efficient. It was electronic. It was digital. It hit all these check boxes. But I said, had you considered when you went to an EFT as a payment method, for instance, maybe you standardize your payment terms at net 45 instead of net 30, or net 60 instead of net 45. And you can have a good conversation of bridging that world of process and cost so that everybody makes out here. using that as a lever to gain adoption, to make the technology transition easier, both for our own organization and our partners that we're paying, but also to make sure that we can create some advantages, some cash advantages for the company as they make these transformations.
Just wrapping this section up, any comments about how should organizations think about making it easier for suppliers? Because it has to be beyond just the conversation. I'm sure you've had this, hey, we've got technology. There's technology. There's more to it than just that. What are some of the key things people should be thinking about?
Yeah, I think internally we talked about creating a business case, use your own data, but also I think about the outcome. So in 6 months or 12 months, you've put this technology in, you put this new program in, ask yourself, how will success show up? How will we know that we've been successful? How will our suppliers know this has been successful? So I think it's always valuable when I'll be honest, I encourage my reps to ask that question, because then you often discover folks they'll pause and think about that for a minute and say, oh, okay, this is how we'll know. I guess this is how we would know the suppliers are using it, or this is how we'd see X amount of increase in working capital. So that's a good question I encourage folks to think about, is how will you and your stakeholders know it's been successful in 6, 12, 18 months? The other thing for suppliers, I do think it's a case of just because you build it doesn't mean they'll come. I've had one CFO describe his suppliers as ankle biters. They're desperate to know when they're going to get paid. And that can often take up 20 to 25, 30% of the time of the AP staff, just answering phone calls and emails. When are you going to pay us? What are you going to pay? Which invoices are you going to pay off? Their AR teams, their cash application teams need that information. You can put that information into a portal and make it readily available and allow them to self-serve, which frees your staff up to go and do more valuable things. But I think the other thing, which is key, LSQ is great at this, you can enable the technology to pay, so you can have the technology to receive invoices, be able to pay those invoices really faster, and at a rate that's attractive to the treasury team at the supplier. But you've got to make it easy for the supplier to say, there's a new tool. I've got to use a new tool to go online, see my payments or accept early payments. Or this is key, where I think, yes, you as the enterprise can be sort of encouraging the supplier, selling it to them, making them understand what the change is. But also, I think you need to team up with someone. And in this case, I say LSQ. They do a lot of if not most of the heavy lifting. And that's important, because it's not just about technology. I mean, I've got a project right now going on in Colorado where that was the key concern for the finance and the leadership team was, we've got to get to learn to use this new tool, and so have our suppliers. So I think you really want to do your due diligence to make sure that whoever you team up with get in the trench and work with you to talk and educate and woo the suppliers to come and use the platform.
Thank you both. I just wanted to give you both an opportunity for any final thoughts or comments, anything to leave an emphasis. I'll start with you, Brian, and then finish with you, Dan.
I think this is top of mind for me because we just closed first quarter, right? Finance teams are wrapping up Q1 financials. We'll all see what this looks like in the next few weeks for the corporate world. But I want to say, I've had a lot of conversations, as Dan said, every company has a working capital initiative out right now. And the thought that's in my head incessantly is a ticking clock. Do not run out of runway. It is for corporations trying to have a working capital impact in 2023. Your job is never easier than it is today. And what I mean by that is, at the end of the day, you have to move spend or receivables, in one way or the other. And you have the advantage of the next 9 months to have the results of those decisions you make today. But if you wait even one more quarter, you're moving literally twice as much money. You have twice as much to lift in order to have an impact by December 31st. It is a critical theme that we don't necessarily think about the impact of time. When we think about working capital, we focus on the dollars and whatnot, but the value of time here is, arguably the most important factor to making your life easier. And taking efforts today, whatever you're going to do, is going to have the best impact at the end of the year when you fill out your results.
Thanks for those comments. And Dan, any final thoughts?
Sometimes when folks think about this, they might be worried about what is the time and the effort to set it up. Because most companies have some kind of ERP upgrade or transformation going on, their IT teams are really, really busy. And I think for many, when they think about this, it's like, okay, so we're talking about working capital, but we're also at some point going to have to engage with the folks in IT to understand, is this going to be a fit for us? Is it going to work for us? How long is this going to take? So I think we shouldn't forget that folks in IT need to be part of the conversation, and they may be surprised once they take a look closer that it doesn't have to be, as long and complicated as they might assume.
Excellent. Dan and Brian, thank you so much. We appreciate your time.
You've reached the end of another episode of the Treasury Update podcast. Be sure to follow Strategic Treasurer on LinkedIn. Just search for Strategic Treasurer. This podcast is provided for informational purposes only, and statements made by Strategic Treasurer LLC on this podcast are not intended as legal, business, consulting, or tax advice. For more information, visit and bookmark strategictreasurer.com.